Okay, folks, as we do every week on this channel, I'm giving you full clerical insight into my over $378,000 dividend stock portfolio as I recently updated the data from the multitude of brokerage accounts that I'm managing so we can get a nice overview, including the recent updated dividend income for this month. After that, we're going to dive into the individual brokerage accounts to show you guys the updates, the stock purchases, and everything that's changed over the last couple weeks. And then finally, we're going to talk about some individual stocks, primarily real estate investment trusts, and how they may be affected through these tumultuous times and what I'm exactly paying attention to with the individual stock holdings. If that is a conversation you can appreciate, in return, I simply ask that you hit that like button, folks, because here is the new and improved and updated spreadsheet that takes into consideration my US stocks that are paying me US dividends, converting it all to Canadian dollars, giving me a total portfolio value today of about $325,735. Again, that just represents the stock values themselves, and what makes up the rest of the value of this portfolio is the $53,000 in cash that I keep telling you guys I've been sitting on a tremendous amount of cash while I just wait to finish up corporate taxes. So this does not take into the tax liability that I will be losing a fairly healthy percentage of this, but I figured I wanted to represent the exact cash value in Canadian dollars. The current cost basis since I updated my portfolio and roughly between the first and second quarter of this year is giving me a total cost basis of around $339,000. On the right side here, guys, we can see that I'm down about 3.9% as it sits today. This is a nice passive spreadsheet that I've created to basically consistently update every single day this portfolio value represented in Canadian dollars. So we're down about 13,000 Canadian dollars again in this very moment. But taking a look at the diversification set here, guys, again, all converted to Canadian dollars, VOO at 33.3%, VDY, which is primarily going to be the stock that I'm focused on for the rest of the year. I'm looking at rebuilding up my VDY position, but in the meantime, another reason I'm stacking cash so aggressively as we've got a few months left to the end of this year, and I want to be able to basically come January max out my tax advantaged accounts without having to sell any of the positions I currently have in my regular brokerage account. So that's another reason that I am stacking cash is for next year's contributions to my tax-free savings accounts. Now on the annual dividend yield basis, guys, I'm only making $8,652. This doesn't take into consideration obviously my high interest savings accounts and a few other things, my crypto accounts that do cash flow a little bit. I just wanted the pure dividend value coming from my stocks, and right now on the portfolio value, it represents about a 2.66% yield. I know it's not a huge amount, but when the market does turn around, I do want to get some growth out of the market, which is again why I buy VOO, SCHD, VYM. That's where I'll be getting most of the growth from with my dividend focused income from VDY, which we can see VDY because it's such a high dividend paying ETF. It is making up about 47% of my total dividend income, which is represented in this pie. But I have a nice diversification set right now with almost 50% or just about 60%, including my REITs, that income coming from Canada. And then, because VOO, SCHD, VYM aren't paying nearly as much as my Canadian stocks, it still, however, makes up a nice, healthy, almost 40% of the entire portfolio's income. Now, from the dividend side of it, guys, we can see that my payments for the entire year thus far, I've calculated work out to be about 7,623 CAD. That's very nice, but as I've continued to adjust the portfolio, the dividend income I am expecting to drop. I was making almost 1,000 a month, 11 or 12,000 annually before I did the adjustments into primarily ETF focused investing. But again, I am looking to take advantage of growth and stabilized income and make this as passive as humanly possible. Now, if you guys like the spreadsheet and the data and you think this could help you specifically, and again, this is coming from a Canadian focused investing mindset, having a multitude of brokerage accounts in US and Canadian asset values, this could really help convert all of it into a streamlined automated portfolio that again auto updates the dividend values and the stock values, and again for the US stocks converts it all to CAD nicely. And same with the dividend income, it's a nice place to just track your monthly dividend income and again convert it all into Canadian dollar values. But I did make the spreadsheet so it does focus purely on US stocks and Canadian stocks, and I did put it together in a recent product that I'm launching on my website, which now is portfoliospreadsheet.com, but you can use any of my old website listings. They all redirect here now. I'm going to leave the link in the description below, and I am running a one-time discount here for $19.99. I'd love for you guys to try this out and tell me what you think about this portfolio spreadsheet that I put hours into, and it's just nice to see all of my combined accounts come into one place. So let's talk about those individual brokerage accounts themselves, starting off with my tax-free savings account. Today, with a total market value of $152,118, we did recently get a little bit of dividend income in here here of about 274 CAD, but I'm not willing to reinvest that because I have to pay a $10 commission on each trade that I do using Scotia iTrade, which would be like losing 3 to 5% of this immediately just reinvesting it. So instead, to avoid the commission, I set up a drip enrollment, a dividend reinvestment plan that avoids me paying commission and then starts paying me out in shares, as I do own really large positions in these ETFs and stocks, which I'll expand more on the drip in a moment. But taking a look, VDY is down about 1.41% since the total purchase, guys. I got 1,350 shares currently in this account, and VOO, I'm down about 5.36%, which is a rather large amount. It's about 4,000 US. This is represented in US dollars. It's a severed US account in my TFSA here, guys. And the thing that sucks with VOO is it's the only stock I can't reinvest, because currently I'm getting about $1,139 in my TFSA, which, you know, that payment divided by 4 is something like 280 or 90 bucks, which really sucks because on that quarterly payout, it's not nearly enough to cover the $356 share price that VOO currently holds. It'd be real nice to own enough of the S&P 500 to get a full dividend reinvestment quarter over quarter. But hey, in the meantime, VDY will be dripping. And another reason that I was using the spreadsheet is we can see the annual dividend calculation from what Scotia iTrade is doing says that I'm getting 4.88%, which isn't accurate because VDY pays out monthly, but it's scattered because each one of those stocks that it holds in the ETF will pay at different rates at different times of the months and year. So basically, this is taking the last dividend payment and then projecting it out over the next 12 months, which is why I'd rather use the spreadsheet. I find it pulls the dividend data a lot more accurately because it says I'll make about $2,833 off VDY, but that will adjust as the monthly payout adjusts. Now, kind of moving forward into my RRSP, guys, this is where I really like the drip enrollment because I have SCHD and VYM, my two US dividend ETFs, and luckily the share prices are just low enough on these that the dividend payout can actually cover about 2 shares for each of these every time I get a dividend, which is really nice because I'm making about $1,579 US dollars off of these 2 investments. But we can see my RRSP is valued at about 60,749 CAD as of this moment. And also keep in mind, the reason that I hold my US dividend stocks in my RRSP is because there's no over the border withholding tax. So it's a great place to hold those US dividend stocks. Now, finally, my managed account worth about $34,844 today, where I did get some more dividends as well, guys, is where I'm primarily going to be fixated on moving forward because I do want to continue to expand the VDY position in here, which I'm down about 2.73% on. My Smart Centers position here, guys, is another one that I want to start reinvesting into because the dividend yield is currently so high, along with RioCan, and I'm currently getting hit the most on Smart Centers as these stocks are getting a lot more suppressed in the current market and interest raising environment because obviously REITs are leveraged and they're going to be hindered by those interest rates. So we're going to discuss more of that. But luckily, I do own enough of all of these to get really nice reinvestments every single month in these individual holdings. And again, these will be taxable. So at some point, there is going to be taxation even on the reinvested cash. But nonetheless, to avoid the current commission cost, that $10 commission on each trade. In the meantime, I can use my working income as some cushion to cover the tax difference. But currently I'm making about $1,929 annually off this account. Again, not taking into consideration some of the adjustments as VDY's monthly payout changes. But nonetheless, guys, these are the 3 primary brokerage accounts. It does not take into consideration my corporate account that has a stock market value today of around $80,000 that does get represented on the spreadsheet, but I have not updated the spreadsheet with my small cap investments and my private placements. I'm going to be doing that for a later video in the next coming weeks. So look out for that for those individual smaller cap stock purchases that I've talked about in the past on this channel. But the stocks that I've primarily been focused on this week, again, have been RioCan and Smart Centers being my 2 largest individual stock investments. And the reason that I've been fixated on these is just trying to pay attention to the interest raising environment and how it's going to affect their income. Because the big thing you got to pay attention to is the payout ratio. And what I really like from RioCan, and you should be paying attention to this on all your REITs, is that RioCan, going through the pandemic, they cut their dividend and they've recently started increasing it. But we can see from the funds from operation payout for this recent 6-month end, guys, for the first half of the year has dropped down to 57.3% versus 81% this time last year. So in the interest raising environment, what I've been doing here is kind of scrummaging around and looking at RioCan's current interest rate on their mortgages. So we can see that the current revolving unsecured operating line of credit they have as of basically the average contractual interest rate on the amounts drawn under this facility was 3.54%. But we can see last year that was as low as as 1.9%. So we're definitely seeing them start getting impacted by the rising interest rate environment. And I love reading through like their construction line of credit and bank loans is currently sitting at 3.17% versus 1.75% this time last year. And it's nice to see that we're getting a lot of client renewals as well that have been coming up on the last quarter. So I just want to make sure that their clients are stabilized and that they have enough room to continue paying that dividend in the interest raising environment, which one that scares me a little bit still is Smart Centers, because their current payout ratio, guys, is about 86% versus this time last year where they were sitting at about 102%. So it's just something to pay attention to, that if the interest raising environment starts to hinder the cash flow that much, which again, I think REITs have a lot of controllable, costs like their amortization costs within their balance sheets. So I do think that both these stocks are going to be able to continue to pay their dividends. But if I had to pick one over the other, I'd say RioCan is a lot more secure. Yeah, the dividend's only 5.17%. But again, because RioCan's done such a good job at rebalancing their balance sheet coming out of the pandemic, I would put a little bit more faith in what they're doing over Smart Centers. But this is something that I'm going to be diving down into a lot more over the coming weeks, as I want to make these investments a lot bigger while also reinvesting the dividends. So those are the stocks that I'm looking at. Again, I would take all this into consideration with any REITs you own and really start fixating on this interest raising environment, because these are the kind of stocks that are going to get hindered greatly, as they usually have, a larger outstanding debt. Now let's talk about the S&P 500 here, guys. Just take a broad view of the markets this week. We can see that, in the last month, the S&P is down about 6%. Year to date, we're trending back down. I don't know. And it's hard to make predictions, but I really am getting a feel that this is generally the bottom of the market. We could retest these lows, but even if we do, I just can't see us going much lower than where we're at, because as soon as inflation rolls over, and like I told you guys, it's not going to be slow, it's going to be quick, because basically, even though the last interest CPI data coming from the Fed said that it came in above expectations, I'm promising you, because of how commodities are rolling over right now, inevitably that's going to end up hitting the market, and we're going to start seeing inflation probably roll over quicker at some point than expected, because it's going to be like a ball rolling down a mountain. As we head down that mountain, it's going to go quicker and quicker, and I'm curious to see how the market responds to that, as negatively as it's responded to the current CPI data. The Nasdaq currently trading down 27.49%, and the TSX S&P is only down 8.62%, and that's where we currently sit for the week, ladies and gentlemen. And I want to pass the question off to you. I'd love to know what you guys think about all of this in that comment section below. How have you been adjusting your portfolio? What stocks have you been buying, and what have you been paying most attention to in these interest raising tumultuous times? I'd love to hear about all of that. But stay cool, stay awesome, and as always, I look forward to catching you in the next one.